Hi, I'm Linda Eedes, and today I'm going to be giving you an update on the RECM Global Fund. The market environment is very uncertain of late, and it feels very uncomfortable as an investor to sit through the volatility that we've seen in the marketplace over the last year and even accelerating over the last few months. As active investors, we believe that volatility is actually a good thing. You have to have mispriced assets to be able to take advantage of that and actually be able to beat the market, so to speak. So as value investors, we're looking for those assets which are priced too low and staying away from those assets which are actually priced too high. And there are many of those in the market environment today as well. So it's twofold: taking advantage of those investment opportunity where a value opportunity exists, and steering clear from those assets which have done very well historically, but which represent risk of real permanent capital loss at this point in the cycle. Now, the fund is positioned very well to take advantage of that at the moment, and that's for two reasons. The first has to do with the overall asset allocation of the fund. So the fund is sitting with just under 40% in cash at the moment. Now remember, we're bottom-up investors, so our cash position is a byproduct of how many investment opportunities we can find at this current moment. So we don't decide to have 40% in cash. What happens is we look in the global universe for as many quality businesses as we can find that are trading at good prices. We buy those businesses, and whatever's left over is our cash position. But what you typically tend to find is that when you're facing a very risky market environment where a lot of assets are overpriced and thus vulnerable to significant correction, we do tend to end up with quite a large cash position. And prior to the financial crisis, it's interesting to note that the Global Fund had a similar amount of cash in terms of the asset allocation. Now, cash is a great thing to have in this kind of market environment for two reasons. First of all, if you have a broad market sell-off, the cash obviously protects you. So that portion which is in cash is obviously immune to that market correction. And that's very different, by the way, to a tail risk strategy, which is made up of derivatives. Cash, you know how that's going to behave. Often with derivatives, you don't know how they're going to behave until you face that market circumstance. Second of all, cash gives you a wonderful opportunity to actually buy assets as the market sells off and provides you with the opportunity to do so. So it gives you that dry powder to actually deploy into the market as the market gets cheaper. And that's precisely what we did during the financial crisis as well, where we took our equity exposure from about 55% of the total fund to in the mid-90s after the dramatic sell-off in the market. The fund is also positioned very well in terms of where we have exposure. Now, as value investors, obviously we want to take advantage of the cheap opportunities in the market. Those businesses which are trading at prices which do not reflect the long-term scenario for that company through the cycle. Now, you'll be well aware that one of the most compelling opportunities that we see in the global marketplace is in resources and other cyclical businesses. And we still believe that very firmly, and as a result, a third of the equity in the fund is exposed to mining companies, oil and gas producers, and the like. However, as the cycle has gone through, what we've realized is that it's probably going to be a longer cycle than we expected. And the main reason for that is that supply is not being shut down as quickly as it should be given where commodity prices are today. So the producers are reluctant to dial back their production because they too are hoping that commodity prices are going to turn around and save them the headache of dialing back production, shutting down shafts, getting rid of labor and the likes. So unfortunately what that does though is it does lengthen the cycle, and it makes lots of businesses vulnerable to business failure. So if you don't voluntarily go through the capital cycle by shutting down production, eventually the market forces your hand. And what we've been very careful about is where we have our exposure amongst the resource companies. So that has resulted in a few adjustments in terms of where our resources exposure is. We've been able to switch some of our exposure into the better quality resource businesses, which are now very cheap as well as a result of the sell-off in the last quarter of last year. And a few examples of that would be, for instance, reducing exposure to energy companies like Ultra Petroleum and increasing exposure to companies like Inpex, reducing exposure to companies like Amplats and Implats in favor of a company like BHP Billiton. What the broad market weakness has also allowed us to do is to diversify into other sectors. So 2 years ago, really the only compelling opportunity in the market was the cyclical companies and the resource businesses. Now with what's been happening lately, we're seeing a lot of opportunities popping up in other sectors of the market. And that's a great thing because it allows us to diversify the overall portfolio more while still having value opportunities across the board. And that's really what you want. You want a portfolio that is well diversified, but still taking advantage of those value opportunities and still has some cash to deploy as the market gets weaker and provides you with the opportunity to do so. So in conclusion, the fund is well diversified. It's still taking advantage of the most compelling opportunity set today, which is in the resources and cyclical space, but it also has that chunk of cash which provides a buffer as well as dry powder to take advantage of future opportunities. The fund has actually done reasonably well over the year to date in comparison to many peers and certainly in comparison to the MSCI All Country World Index, which is down substantially. And some of that suggests that perhaps, maybe too early to say, but perhaps there is a turning in the tide. Thank you very much.